Times Roman Publishing Company reports the following amounts in its first years of operation. Alright, now if you follow with me on the with my mouse, the pre-tax accounting income was 250, then 240, and 230, and we'll assume these dollars are in millions. Taxable income was 290 million, then 220 million, and 260 million. Okay, now continuing with the text. The difference between pre-tax accounting income and taxable income is due to subscription revenue for one-year magazine subscriptions being reported for tax purposes in the year received, but reported on the income statement in later years when the revenue is earned. The income tax rate is 40% each year. Times Roman anticipates profitable operations in the future. Alright, so let's look at the first requirement. What is the balance sheet account for which a temporary difference is created by this situation? And we have a choice. It's either the earned subscription revenue or the unearned subscription revenue. And hopefully you recognize that the balance sheet account is the unearned subscription revenue. And let me explain why that is the case, and I'll put the answer in front of you as well. A liability for unearned subscription revenue is created when subscriptions are received. That means we debit cash and we credit the liability for subscriptions. But for tax purposes, there's no liability being recorded. This causes a temporary difference between the financial statement carrying amount of the subscription liability and its tax basis. Alright, now let's take a look at Part 2. Part 2 says, for each year, indicate the cumulative amount of the temporary difference at year end. Okay, now I moved the images on the screen so we can get it all in the screen real estate we have available here. Alright, well the temporary differences are 40 million in 2009, 20 million in 2010, and 50 million in 2011. Oh, and I see here that these are supposed to be in thousands, so that's 40,000, 20,000, 50,000, and the previous numbers here were all in thousands as well. Okay, so how did we determine those temporary difference? Well, in 2009 we had 250 versus 290, so a 40 million for accounting basis. Tax basis is 0. In 2010 we had 240 versus 220, so an accounting basis of 20 with a temporary difference of 20. And then in 2011, 230 versus 260, and the accounting basis at that point is then 50 million, and hopefully you can see how that calculation is made. Right? 290 but minus 250 in the first year gets us 40 million. Then we've got a 20 million going the other way, and then a 30 million difference that we have to calculate in the carrying amount on an inception to date basis. So we're able to compute the temporary differences. Next we tackle item 3, which is, or requirement 3, which is determine the balance in the related deferred tax account at the end of each year. Is it a deferred tax asset or a deferred tax liability? Okay, and now we see that for 2009, 2010, and 2011 we had a deferred tax asset of 16,000, then 8,000, and 20,000, and the calculation appears down below. We take the temporary difference times the 40% tax rate to calculate a deferred tax asset of 16,000. Then we go through that same calculation again for 2010, which is 20,000 times 40% to give us 8,000. And then in 2011, we take the 50,000 temporary difference times the 40% tax rate, and we come up with a deferred tax asset of $20,000. And that's this problem, everyone. Thank you.